If you've been tracking the institutional flow of funds with the same scrutiny that I have over the last decade, you know that the price action often whispers before it screams. For the better part of the last 18 months, the Indian IT sector has been the market's forgotten asset class. It was consolidating in tight range, it was frustrating retail holders who bought at 2021 peak, and it was severely lagging behind the high beta themes like defense stocks, railway stocks, and PSU banks. But that narrative has shifted dramatically in the last 30 days. Since early October, the Nifty IT index has rallied approximately 7%, significantly decoupling and outperforming the broader Nifty 50 index, which has actually seen some distribution and fatigue. We are not looking at a mere dead cat bounce here. We are looking at a calculated, high volume rotation of capital from global allocators. Today, I want to dissect this move with the depth it deserves, moving beyond the superficial headlines to understand the precise valuation models, the flow of institutional money, and exactly what this means for your portfolio allocation in 2025 Q4. Now, before we get into the granular valuation data, and we will get very granular today, I want to address how we analyze these pivots. In my years of trading and analysis, I have learned that the difference between an amateur and a professional is the ability to spot the why before the what becomes obvious on the screen. If you're serious about moving beyond surface level tips and want to understand how to structure a portfolio that withstands volatility using institutional methodologies, I strongly suggest you join my exclusive webinar. The details are in my Telegram group, link is in the description. For today's analysis, I've used my own portfolio modeler tool, which I'm giving away for free. If you want the tool, comment portfolio, PORTFOLIO, down in the comment section. Let's start with the macro thesis driving this 7% surge. We are witnessing what I call the anti-AI rotation. For the last 2 years, global liquidity has been sucked into a massive vacuum by the US AI narrative, specifically Nvidia, Microsoft, and the hyperscalers like Google and Amazon. However, in the last month, we have seen the first genuine signs of fatigue in that trade. Global allocators are beginning to fear an AI valuation bubble as capex numbers are swelling without immediate revenue justification. When Wall Street gets nervous about growth at any price, they rotate aggressively into growth at a reasonable price and defensive cash flows. That is exactly what Indian IT represents right now. It is a value pocket of the global tech ecosystem. This is not just a theory, the data backs it up. Domestic mutual funds who were historically underweight on IT have ramped up their exposure to 7.6% in October. It is a sharp rebound from a 67-month low. The smart money is re-entering because they see a floor in valuations that does not exist in the overheated US tech stocks. Now let's get into the meat of the matter, valuation. This is where the real story lies, and it is where most retail investors get it wrong. Now, if you're not subscribed to the YouTube channel yet, please make sure that you subscribe by clicking on the button. Now, you cannot paint the entire sector with the same brush. When we run a 5-year historical PE comparison, the sector splits clearly into two distinct baskets, the value anchors and the momentum premiums. Let's look at the value anchors first. TCS is currently trading at a PE of around 22.7. To put it in context, the 10-year historical average is around 26.4. You are getting the industry leader with the best margin defense in the world at roughly 15% discount to its long-term average. That is a margin of safety that value investors live for. Similarly, Infosys is trading at a PE of 21.4 against a 5-year average of 24.5. This discount is precisely why management launched the 18,000 crore buyback at 1800 rupees per share. They know that their stock is undervalued and they're using their balance sheet to force the market to recognize it. This buyback creates a massive technical floor. Large funds know that the downside is capped, which encourages heavy accumulation. On the other side of the spectrum, we have the momentum premiums, where the market is pricing in aggressive growth. HCL Tech is the prime example here. Unlike its larger peers, HCL is trading at 25.5 times PE, which is actually above its 5-year historical average of 23.7. Why? Because the market rewards relative outperformance. HCL has consistently beaten revenue guidance and deal win expectations over the last 3 quarters. The market is paying a premium for that execution reliability. Then you have the mid-cap darlings like Persistent Systems and Coforge. Persistent is trading at a searing PE of nearly 59x, significantly higher than its 5-year average of about 50. Coforge is seeing a similar expansion, trading at 48 to 50 times normalized earnings. Now these stocks are no longer value plays. They are pure growth momentum trades. Investors here are betting that these companies will continue to capture discretionary spend faster than the giants. It is a high risk, high reward game. If you are buying Persistent today, you're not buying cheap. You're betting that the earnings growth will accelerate enough to justify the multiple expansion. Interestingly, L&T Technology Services presents a unique anomaly. It is trading at a PE of about 35x, which sounds expensive compared to TCS, but it is actually a discount compared to its own 5-year history, where it commanded multiples of 43x or higher. This suggests that while engineering R&D space has been hit hard by the slowdowns, the market might be underpricing a recovery here. If you believe in the manufacturing and industrial recovery in the US and Europe, LTTS offers a contrarian entry point that is statistically cheaper than its own historical trend, even if it looks expensive optically compared to IT services. So why is this broad re-rating happening now? It is a confluence of three specific catalysts. First, the US Federal Reserve is cornered. Recent weak job data in the US suggests that the labor market is cooling faster than anticipated. This has reignited the consensus view that the Fed will be forced to cut rates in late 2025 or early 2026. Lower interest rates are rocket fuel for Indian IT. When the cost of capital drops for US corporations, their discretionary budgets for change the business projects opens up. We are moving from a cost optimization cycle where clients just want to save money to a transformation cycle where clients spend to grow. And that shift is where Indian IT makes its biggest margins. Second, there is a geopolitical tailwind. There is a significant buzz in Washington and New Delhi regarding a potential trade deal between US and India. Markets are forward-looking mechanisms and they are pricing in a friendlier trading environment and potentially easier visa norms for skilled professionals. And this would directly boost margins for our exporters, especially service exporters. However, just to be on the safe side, I must highlight the bear case risks. We cannot ignore them. The biggest risk to this rally is a hard landing in the US. If the US economy does not just cool down but actually dips into a recession, IT spending will evaporate regardless of interest rates. In 2008, IT stocks corrected 50 to 60% because demand vanished. Now, while balance sheets are stronger now, the stock price will not be immune to a US recession. Secondly, there is the currency risk. The rupee has been relatively stable, but any sharp appreciation of the INR against the dollar will eat directly into the operating margins of these companies. Every 1% appreciation in the rupee typically impacts IT margins by 30 to 40 basis points. And finally, we have the wage inflation ghost. If demand snaps back too quickly in 2026, we could see a return of the great resignation era. Attrition rates forcing companies to hike aggressively, which would crush the very margins that we are celebrating today. So you need to keep a close eye on the attrition numbers in the upcoming results. So how do you synthesize this into a strategy? The sector is currently in a sweet spot. The bad news, which is the slowdown, budget cuts, etc., is largely priced in. The valuations for large caps like TCS, Infosys, etc., are offering a genuine margin of safety, making them excellent core portfolio holdings for conservative investors. The floor is solid. So for those seeking alpha, the mid caps like Persistent and Coforge are the vehicles of choice, but you have to treat them as momentum trades with strict trailing stop losses because their valuations leave no room for error. If Persistent misses one quarterly estimate, that 60 times PE will contract violently. For those of you who are holding Infosys, if you have a specific time sensitive decision to make today, the buyback window is open. The acceptance ratio, the percentage of shares the company will actually buy back, is the critical variable. Historically, for retail investors holding less than 2 lakh rupees worth of stocks, acceptance ratios can be quite favorable, sometimes more than 15 to 20% or even higher, depending on participation. If you're unsure about the mathematics of the buyback, specifically whether it makes sense for you to tender your shares or hold them for the long term, drop a comment below with your average buying price and holding quantity. I can help you run the numbers to see if your arbitrage will be profitable. This rally is real, but it is selective. The rising tide lifts all boats, phase is ending. Now we are ending the stock pickers market. Keep your eyes on the deal wins, watch the US macro data like a hawk, and do not get carried away by FOMO. Stick to the data. If you want to navigate this professional guidance, check out the course and the Telegram channel. I'll see you in the next analysis. And like again, if you're not subscribed, subscribe to the channel. Thank you so much.